Welcome to the second sessions of the Financial Statement series at the Peterson Institute. I'm Nicolas Véron, Senior Fellow at the Institute. And it's my pleasure to introduce the discussion today, which will be about the G-20 agenda of financial reform. As you know, Financial Statements is a new series. We'll have it every other week. So we're looking forward to a number of themes related always to the financial sector and policy challenges related to it. We alternate every week with the Trade Wind series, which is coordinated by my Peterson Institute colleague, Annabelle Gonzalez, which has also stellar panels to discuss trade-related issues. So last week was trade, next week will be trade, and in 2 weeks' time will be finance again. Today's theme is the G20 financial reform agenda, which was shaped in the course of the previous crisis, particularly after the collapse of Lehman Brothers 10 years ago, 12 years ago. The Financial Stability Forum, which had been created in the late 90s in the aftermath of the Asian financial crisis, was upgraded to a Financial Stability Board. The G20 group of finance ministers and central bank governors was upgraded to a group of political leaders and G20 summits. And at the beginning of that sequence, particularly in 2008 and 2009, the emphasis was very much on financial reform as opposed to more themes of macro or international finance or trade or development policies. So financial reform was really at the core of that agenda 12, 11 years ago with the G20 summits of Washington, D.C. in November 2008, London in April 2009, Pittsburgh in September 2009. And that's the legacy that we will be discussing today. How much of that reform agenda has been validated, how much of it is unfinished business, and of course, to which extent does the COVID-19 crisis lead to new directions in terms of future reform? I should make a due personal disclosure, which is that part of that agenda was about derivatives reform. I think we'll come back to it. And I myself, for several years, have been an independent non-executive director at the Global Trade Repository operation of DTCC, which is a pretty arcane activity, but which just is affected by this policy agenda. I don't view it as a conflict of interest, but I think the disclosure is apt. Many thanks to our two guests today. Dietrich Domanski is the Secretary General of the Secretariat of the Financial Stability Board, which is based in Basel. He took that position in January 2018. And before that, he had held a number of positions in the Bank for International Settlements, also in Basel, particularly in the Monetary and Economics department. He joined the Bank for International Settlements in 2000. And before that, he had worked at the Bundesbank in Germany, at the IMF in Washington, D.C., and also as an advisor, I think, from the IMF to Bank Indonesia, the Central Bank of Indonesia in Jakarta. Caroline Atkinson will be our second guest. She's had an incredibly rich career as a journalist, including for the Washington Post, The Economist, The Times of London, and prominently as a public servant at the Bank of England, at the US Treasury, working with Robert Rubin, Larry Summers, David Lipton, and others. And of course, at the International Monetary Fund, where she was in the senior management. And in particular, she was in the Obama White House as Deputy National Security Advisor for International Economics, and in particular, with authority in that team during the Obama years for G20 processes. So that's a particular aspect of this incredibly diverse career that I think we will be particularly interested in today, but she also was a senior manager in the leadership of Google. She's now a senior advisor at Rock Creek Investment Group, a board member at Brookfield Property Company, and perhaps more importantly for many of us, a board member at the Peterson Institute. So enough for my introduction, and Dietrich, the floor is yours now. I will hold your slides on the screen, so please direct me on when I should switch to another slide. Thanks very much again for participating in this session.
Thank you very much, Nicolas, for inviting me. And before I start, can you hear me?
Yes.
Very good. So thanks again for inviting me, and thanks for selecting the Financial Stability Board and the G20 reform agenda as the topic for today's financial statement. I should say upfront that the views that I'm expressing in today's session are mine and do not necessarily reflect those of the FSB or its members. Could you move to the next slide, please? COVID-19 represents the biggest test of the post-crisis financial system to date. The pandemic constitutes an unprecedented global macroeconomic shock, pushing the economy into a recession of uncertain magnitude and duration. This exogenous shock has placed the financial system under strain along three main dimensions of risk. The first is operational risk. Precautionary lockdown measures have tested contingency plans of financial institutions, and remote working may have challenged the execution of complex market operations and centralized functions. The second is liquidity risk. In March, downward revisions of expected economic activity and heightened risk aversion led to a major repricing and repositioning in global financial markets, putting pressure on market liquidity. The preference for cash and near cash assets led to a massive increase in the demand for funding liquidity. The third is credit risk. Corporate credit quality is deteriorating on a broad base. Unlike in previous downturns, services and manufacturing sectors have been hit simultaneously, and there are pre-existing vulnerabilities, not least in the form of high debt. At the same time, the demand for credit is expected to rise. Against this backdrop, the FSB has reprioritized its work program to provide effective support to our members and stakeholders more generally in their response to COVID-19. The FSB is supporting international cooperation and coordination on the COVID-19 response in three ways. The first is assessments of financial stability risks and vulnerabilities that might lie ahead as the impact of COVID-19 on the global economy unfolds. The second is work to inform policy discussions. And the third is that we are working with our membership to coordinate on global policy responses. I'll come back to these activities in more detail later. Next slide, please. So one main question for today's meeting is what COVID-19 means for the G20 reform agenda. And before turning to this question, it may be useful to recall quickly the main elements of the G20 reforms agreed after the 2008 financial crisis. And these reform elements have been coordinated by the FSB. So the slide that is in front of you shows these four main reform areas, and for each, the key reforms undertaken. So the first is making financial institutions more resilient. At the heart of this reform effort has been Basel III. The second pillar is ending too big to fail. And this reform area includes higher capital and loss absorption capacity, more intensive supervision, and importantly, resolution frameworks for systemically important financial institutions. The third reform area is making OTC derivatives markets safer. This has involved central clearing, trade reporting, platform trading, and margin requirements for non-centrally cleared derivatives. And fourth, there is the area of enhancing resilience of non-bank financial intermediation. And here the relevant reform areas include money market funds, securitization, and securities financing. So if you consider the breadth of this reform agenda in its entirety, I think it's fair to say that the G20 reforms have profoundly changed the global financial system. Next slide, please. And bearing this fundamental transformation in mind, COVID-19 is as much a test for the G20 reforms as it is for the financial system. Now, what can we say about that? I think it's fair to say that overall, the global financial system has proven more resilient and better placed to sustain financing to the real economy as a result of the G20 regulatory reforms than it was in the aftermath of the 2008 global financial crisis. 3 points to make here. First and foremost, there is greater resilience of major banks that are at the core of the financial system, and this greater resilience has allowed the system to date largely to absorb rather than amplify the macroeconomic shock brought about by COVID-19. Second aspect concerns financial market infrastructures, particularly central counterparties, which have functioned well despite a challenging external financial and operational environment. And third, there are those forms of market-based finance that contributed to the 2008 financial crisis, securitization structures in particular, that today pose significantly lower financial stability risks. Now, nonetheless, given the unprecedented scale of the shock, key funding markets experienced acute stress, and authorities needed to take a wide range of measures to sustain the supply of credit to the real economy and support financial intermediation. It is obviously too early to draw definitive conclusions about financial resilience. The pandemic is still unfolding, and the scale and duration of its economic impact is uncertain. The financial system faces a dual challenge. On the one hand, to sustain the flow of credit amidst the global recession, and on the other hand, managing at the same time growing solvency risks. And against this backdrop, policymakers need to ensure that the financial system can continue to provide financing to the real economy under different recovery scenarios. Financial stability is a necessary condition for that. Now, turning to the policy response, authorities in G20 and FSB jurisdictions have taken a wide range of measures to sustain the supply of credit to the real economy, support financial intermediation, and preserve the resilience of the global financial system. The policy measures taken have buttressed resilience of critical nodes in the financial system, including through direct fiscal support and government guarantee schemes to incentivize lending, through measures to alleviate US dollar funding shortages through central bank swap and repo arrangements, through measures to alleviate funding constraints from the shift of investors to safe assets, and through measures to support market functioning and ensure market integrity. As funding market strains have abated, the focus has shifted to addressing a growing need for real economy financing against the backdrop of rising solvency risks. And here, let me just flag 3 points. Authorities and standard setting bodies have first encouraged the use of capital and liquidity buffers to support the economy, provided guidance on the application of accounting rules, and provided flexibility in the application of prudential requirements. At the risk of stating the obvious, many of these measures, and first and foremost the use of buffers, have been made possible by the reforms implemented and the resilience built since the 2008 financial crisis. Next slide, please. Internationally coordinated action to support a well-functioning and resilient financial system and open markets remains a priority. And obviously, policy responses have been tailored to jurisdiction-specific needs, but they have been underpinned by common principles that the authorities have agreed to follow in future to support the real economy, maintain financial stability, and minimize the risk of market fragmentation. So under these principles, authorities will monitor and share information on a timely basis to assess and address financial stability risks from COVID-19, recognize and use the flexibility built into existing financial standards to support the response, seek opportunities to temporarily reduce operational burdens on firms and authorities, act consistently with international standards, not roll back reforms or compromise the underlying objectives of existing international standards, and last but not least, coordinate on the future timely unwinding of the temporary measures taken. The G20 finance ministers and central bank governors endorsed these principles in the April communique. The FSB, working with the standard setting bodies, is monitoring the use of flexibility and consistency of jurisdictions' COVID-19 policy responses with international standards. And we will report on these to the G20 finance ministers and central bank governors at their virtual meeting in mid-July. Next slide, please. This is the last slide. So looking ahead, what lies ahead for the FSB in light of COVID-19? The immediate priority is to support the international policy response to COVID-19 and addressing the financial stability risk from COVID-19, supporting an effective policy response will be our primary focus for the foreseeable future. I already mentioned that the FSB's work program has been significantly reworked compared to what we published in January. You can find further information on that on our website. In due course, the question of the unwinding of policy measures will arise. And as stated in the FSB principles, this future unwinding should happen in a coordinated manner to avoid unintended spillovers across financial sectors and jurisdictions and to avoid harmful market fragmentation. And then there may well be lessons to be learned for global financial stability and financial regulation from the COVID-19 experience. What these lessons will be, we don't know, and we need to be careful not to jump to any premature conclusions. So all I would like to do in concluding is to offer 3 thoughts, personal observations, if you like. The first is that we are seeing macroprudential policy in action, and we are learning a lot about what is working and what may not, or at least not working perhaps fully as intended, including about the role of buffers through the financial cycle. When to build buffers, when to release them, and how to release them. Second observation concerns the question whether and how structural changes in the financial sector may have affected financial stability. The growth of non-bank financial intermediation over the past decade is a case in point. This growth has added welcome diversity in the provision of finance, but at the same time, the impact of COVID-19 on credit markets and sometimes of investment funds has highlighted potential vulnerabilities in this increasingly important sector. And well, by the same token, also highlighted the need to understand the risks and the resulting policy implications. My third and last observation is on the role of the FSB going forward. COVID-19 has shown again, or is showing again, that financial stability policy requires a holistic view of the global financial system. Bank and non-bank credit are closely interlinked. Households may shift savings swiftly from money market funds to banks and between emerging market and advanced economies, just to give a few simple examples. The FSB, with its broad membership, central banks, bank and market regulators, ministries of finance from both advanced and emerging market economies, international standard setters, and international organizations, this broad membership puts the FSB in a unique position to take a holistic perspective that is needed for financial stability policy. And with that, let me hand back to Nicolas.
Nicolas, we can't hear you.
Oh, sorry. Here's a mistake. Thank you. Thank you so much, Dietrich. This was very rich. There is a lot to unpack here. In the great tradition of Basel, you gave us a very consensus-sounding view of things that are actually extremely contentious and disputed. When you talk about fragmentation, compliance, coordination, for example, there was a recent communication of the Institute for International Finance, warning against financial protectionism, and obviously there are lots of concerns around these days, which were just lurking behind the surface. But you mentioned an extremely rich range of topics, and we'll do our best to come back to them in the rest of this discussion. But first, Caroline, how do you see it as a practitioner, and particularly a practitioner of the G-20?
Thanks very much, Nicolas, and thanks very much, Dietrich. So I want to pick up from where Dietrich left off about the special nature of the FSB and make 3 points from a sort of policy political point of view, and then a couple of brief points on the challenges ahead. So my first point is about the origins of the FSB, which Nicolas outlined a bit. The Financial Stability Forum, its predecessor, began after the Asian crisis, and I was there in the room when Hans Tietmeyer came to talk to Larry Summers and Bob Rubin, because we at Treasury had this feeling during the Asian financial crisis that whilst we had close cooperation with our central bank and with G7 finance ministers and central bankers, there were 2 elements where those groups were too narrow. One was regionally. The G7 clearly excluded an important part of lots of important economies. And so we broadened it out to the G22 and then the G20. And the other was on the topics, because central bankers and ministries were getting together, but there were an awful lot of regulators of markets, especially in the US. There are lots of different regulators, including inside the Treasury Department. And we felt that as treasuries, we wanted also to be involved in the decisions that were important and that would be made by those groups. So it was a very politically motivated move. The only thing that made Tietmeyer willing to contemplate this and to agree on the establishment of this new body was that in turn the US agreed that it should be centered in Basel, and that the first leader would be Andrew Crockett, who was then the head of the BIS. And then of course we saw how useful it was when it became broadened to the FSB. So my next point is that as David Wilcox said in your first session, Nicolas, this recession is really different from earlier ones. Earlier ones have come from central banking activity or financial instability of one kind or another. And the financial system, financial stability issues have been right at the center of those recessions and those problems in financial stability, whether emerging markets in the Latin American, Asian, and so on, or obviously importantly in the 2008-2009 crisis. Now, this one is a very different kind of crisis. We all know that it began from health, but it's sometimes worth thinking about what does that mean politically about the role for a financial stability board. It's not so obvious that shoring up the resilience of the financial system is going to grab the interest of politicians in the way that it did. I remember Angela Merkel being very deeply involved in worrying about shadow banking and hedge funds. I remember staying up all night drafting a paper for President Obama, who suddenly wondered about financial systemic risk and what it was and what we meant by it ahead of the G20 discussion in Mexico the next morning. There won't be that sort of political interest from the top, and nor will there be, as we already see, the sort of pulling together at a political level, at least not for a while, that normally comes from the United States, but also from other important countries. So the role, and I'll touch on this a little bit at the end, but the role of any coordinating bodies will be important, but perhaps with less political guidance. My third point is perhaps more controversial, which is that I'm a great supporter and hugely glad that there has been such a swift and creative policy response, including from monetary and financial bodies. And it's been terrific in the United States. Obviously, the Fed began with the old rule book, playbook from the crisis and expanded it to stamp out fears of financial crisis wherever they arose in different markets. Same was true in the ECB. At this point, and we saw an enormous market response as there was gradually the feeling has become in the United States that the authorities are not going to allow there to be a financial crisis. This health crisis spilled obviously into an economic crisis. It's not going to be allowed to spill into a financial stability crisis. That's been the clear message. But in giving that message, the Fed, the ECB, maybe other central banks that I'm not so aware of, have gone into areas that are quite challenging from a sort of traditional view of the role of financial regulators and central banks. So we have the Fed having a Main Street facility that, as Larry Summers commented in another webinar yesterday, sounds very sort of political, like the kind of thing a White House person might dream up. It's got a good ring to it. But should the Fed be deciding on corporate bonds and supporting that very political market. And of course, in Europe, we had the challenge to what the ECB was doing in broadening out beyond the key to support sovereign yields. Now, I think that all of those actions have been very important to cushion the blow to, as Dietrich said, to support the growth of credit or the supply of credit to the real economy, and to minimize the terrible loss in terms of joblessness and business bankruptcies and so on. But this brings me to my two quick points about challenges going forward. There is a big, somewhat technical, but very important challenge, which you touched on, which is about bankruptcies and insolvencies. How are those, and we like to say, oh, you know, the Fed can deal with liquidity, but central banks can deal with liquidity, but they can't deal with insolvency. But those lines, as we all know, are very blurred because, you know, if you have a different interest rate, some apparently insolvent businesses can look solvent. If you have a provision of official credit, an illiquid company, or if you have a lack of credit, an illiquid company can topple into insolvency. So as those lines, and we can expect a wave of bankruptcies and a wave of support from governments, but also maybe from central banks to particular creditors. And how will that get organized? And how should financial institutions think about that? And how should regulators think about that? We kind of know about bankruptcies proceedings, but we also know that at times of big financial crisis, usually those aren't sufficient. And that's why you bring together political and central banking. That's why you think about systemic stability and how to manage that shift. And again, Peterson Institute put forward a very interesting paper with Olivier Blanchard and Jean Pisani-Ferry about how to make that bankruptcy process a more a cleaner one than otherwise, but I think there may be a lot of practical difficulties with that. So that's a big important work, I think, for the FSB. And my last point goes back to Dietrich's last point, which is the FSB can bring together the executive branch through the ministries of finance, as well as all of the regulators. And I would encourage you to put on your challenge list, where is that perimeter? And how do you manage that perimeter between the financial public sector and the non-financial public sector? And and we've seen in Europe that in response to the GCC challenge to the ECB, we had a political response from Angela Merkel and
Constitutional Court.
Exactly. I'm sorry. And we had that political response from the European Commission, and before that from Chancellor Merkel, French President Macron. We haven't quite seen a political response like that in the United States. Congress is taking a bit of a pause on fiscal measures now, but I think that will be a really important issue that actually does require political direction at leaders level, and that's the way forward. Okay. So thank you very much, Nicolas.
Thanks, Caroline. That was superb, and I think we have the set scene for a very good conversation in our remaining half hour. I will start with a question to Dietrich, which is about, by professional duty, I'm sure you will be cautious about commenting on extremely political topics, but there is a bit of this paradox between the general sense that the world is fragmenting, there is a lack of international leadership. And actually, when you look at central bank coordination, but also in individual jurisdictions, coordination between central bank and treasuries or fiscal authorities, the track record of this episode with COVID-19 has actually been pretty good. So my question, let me ask it this way. How do you compare the atmospherics and dynamics of international cooperation seen from your perch between now and what you observed at the time of the previous climax of crisis in 2007, 2008. And of course, you need to unmute yourself.
So can you hear me?
Yes.
Good. So well, that is of course a very good and highly relevant question for the broader context in which our work evolves and the environment in which we will have to deal with the challenges that Karen mentioned, that I mentioned. Now, as a lot of caution, qualification, I should say that during the global financial crisis, I was in a different role, so I don't have the direct comparison between the discussions that took place in the G20 and the nascent FSB at that time and now. But given everything that I've heard from, I remember from that time, still in the PIIE tower and from colleagues, I think the big difference in a nutshell is that 2008 was a global financial crisis, right? And there was, as Caroline mentioned at the time, a clear sense that that collective action is needed to address the glaringly obvious vulnerabilities in the global financial system. Right? So I think that was today we are in a situation where we are dealing with a global health crisis that has had a huge impact on the real economy, but it has not turned into a financial crisis. So the environment is different, and the political priorities, just considering these differences in the nature of the shock, are different. So now coming perhaps to the question of what does it mean concretely for our collaboration, I think we have seen very close interaction over the past couple of months in the FSB with our members, a large number of conference calls and virtual meetings, and very good cooperation on crisis-related issues. However, the focus so far has been different than in 2008 because it has been about, if you like, crisis management. And preventing an economic crisis turning into a financial crisis, and at the same time supporting the real economy.
So I'll pick up on your point that this is not a financial crisis, but we have a question from Brian Polk about this. Isn't it inevitably going to become a financial crisis? You mentioned the point about solvency risk, corporate credit. How can we imagine a scenario that, given the magnitude of the shocks, the downward revision of GDPs that the IMF, for example, has recently provided, can we really expect that there will be no system-wide financial fragility, for example, in the US, for example, in Europe, and certainly in other jurisdictions as well? Can you give us a sense of the current thinking about that and what you observe from where you are?
Well, I would say that there's clearly no case for being complacent, right? I mean, the pandemic is still unfolding, increasingly hitting emerging market economies, and while we are seeing early indications of a recovery in economic activity, primarily in the advanced economies, it would be clearly premature to declare that the crisis is over. Far from that. On the other hand, and that gets back to my point about enhanced financial resiliency, I think we are in a much better position, at a much better starting point, if you like, than in 2008 or 2009 during the last recession. And of course, a lot will depend on continued effective policy response and support. And I think if you look at the results of stress tests, Bank of England, ECB, others, I think this shows that the level of resilience that has been built in the financial system can be sufficient to cushion the shock and get on a path of sustained recovery without a financial crisis. So again, no reason for complacency, but also no reason for excessive pessimism, I would say.
Nicolas, can I just jump in here?
Please.
So I think there are a number of people that are pretty concerned about not the resilience of the financial system, and obviously not the banks at the core of the financial system, but about the indebtedness of the corporate sector and of the household sector in some cases going into this crisis. And there is an expectation, as you and I both said, that there will be, that the debts, maybe that some countries have, certainly that some corporations have. We know a number have been filing for bankruptcy. It was just another one this morning, another big one this morning in the United States. We also know that there has been a deferment of payments. For example, I think there was a report that 73 million student loans have not been being serviced in the United States for the last 3 months. There are over 100 million loans in general that are not being paid. People have not been paying rents. And there is quite a push for permanent abatement, which of course then will lead, there will then be the need for some sort of negotiation between these.
Sorry to interrupt you, Caroline.
No, that's fine.
The question, just to pick up on this, the question is not whether credit losses or failures will mount, which I think is inevitable, but really whether the financial system with their buffers and the different mechanisms of risk mitigation that are in place can absorb that. And I guess the answer that Dietrich just gave us is
yes.
Well, he said it's not implausible. He said maybe not, but maybe yes, as I heard it, and he will correct me if I heard him wrong. Do you agree? Do you think there is a path where we escape the phase of financial fragility, or are all the red light flashings that you mentioned going to inevitably create an episode of financial distress at the level of the system?
I don't think it's inevitable, but I think that it is a risk. And I think that what we need to be considering is how will those debts get resolved, because they will be so large and so widespread, potentially, depending on the health, that the normal mechanisms may not be sufficient, the normal mechanisms for sharing out the losses.
Dietrich, how do you think about that one? How will those debts be resolved? I mean, Caroline, in her previous intervention, mentioned the fact that bankruptcy mechanisms are often not sufficient in a systemic crisis. So do you think that we've already seen a lot of risk being taken over by sovereigns. Will we see just more of that, or will there be new mechanisms to absorb the pent-up need for restructuring?
Well, obviously, again, a critical question. Critical from a number of perspectives. I mean, one perspective is the systemic risk perspective and the capacity to share losses, allocate losses in a way that prevents financial instability from happening. And I think this is an area that requires work and careful thinking and initiative, and I think we are seeing it in a number of jurisdictions, not least in the euro area, I think. And at the same time, I think at this point in time, it's difficult to come up with any reasonably robust predictions as to what would happen. I think working on solutions is important. How exactly they will look like, I think will have to partly depend on the development of the recession. Now, the other quick
example.
May I just so may I just give another flag, another issue? I mean, going forward, besides the risk allocation aspect, what is also important is, of course, the question of efficient allocation of capital.
Yes.
Right.
Eventually the ability of economies, the global economy, to manage higher debt levels will depend on growth and productivity, importantly, among other things, right? And in this context, in order to ensure that we do not just get a recovery, but a recovery that takes the economy back to the best conceivable growth trajectory, will require mechanisms that support efficient capital allocation, right?
Yes, and I think that is.
Sorry, Caroline, briefly, and after that, I want to go to other questions because we have an incredible number of very good questions. And time very quickly, but go ahead, Caroline.
I think that's a really important point about how to smooth the reallocation and not stop the reallocation. And that is where the politics and the technical work needs to come together. And I think that's why I suggest that should be a big part of the FSB agenda. That's
right.
And here, just one general observation. So if I may jump in, I said before that it is difficult to come up with sort of blueprints for how mechanisms for loss allocation could look like, what areas specifically should need to be developed. But I think given the high degree of uncertainty that we are facing, I think what is important is to retain diversity in the sources of finance in the range of if you like, institutions, markets, economic agents that are viable and can take an active role in absorbing risk and making informed decisions about capital allocation.
I mean, let me pick up on that very briefly. You mentioned the increase of non-bank finance since the previous crisis in your initial remarks. But to which extent is that really the case? Because if you look at, the big jurisdictions, particularly in Europe, in China, I mean, the US had always had a lot of non-bank finance, and that's not new. But if you look at non-US large financial jurisdictions, the share of bank finance has remained remarkably stable over the last decade or so. So what kind of structural changes have you really observed in those 10 years, particularly as regards the financing of non-financial corporates for their credit?
Right. So from a global perspective, I think the trend is clear. The share of non-bank financial assets in total global financial assets has increased from about 40% to, roughly speaking, in 2010 to, roughly speaking, half. I think the latest figures that we have is 2017. Right? So there has been this trend increase, of course, coming from different starting points in terms of the development of in particular, corporate bond markets, and following a trajectory dependent on institutional circumstances. And if you compare Europe and the US, it's still true that the US is much more, finance is much more market-based than in Europe. Nonetheless, even in Europe, there has been a significant trend increase, for instance, in the issuance of corporate bonds. Right.
I have a question which is slightly contentious from Kurt Scharf at the CFA Institute, and he's asking about stress testing, because there is this new announcement by the Federal Reserve, which I think will be further elaborated on later today, that the COVID-related stress test will not be disclosed in terms of the results on a bank-by-bank basis, but just on an aggregate basis. And obviously that for those of us who remember the Eurozone crisis, and especially the early years, 2009, 10, 11, this evokes some painful memories. How important is supervisory transparency, and how do you see these debates about more or less supervisory transparency from an FSB perspective? And after all that, I will also ask Caroline to react on this. I mean, you may want to skip it because I can understand why this is a no-part question for the.
Well, as a matter of principle, I won't comment on policy measures taken by any individual FSB member jurisdictions, but I can say something about the general point of communication, and here just emphasize that there has been an effort by the FSB and in the FSB context, if I may put it like this, to provide clear signals about regulatory flexibility, the need to coordinate and the case for coordinated action. So in that sense, I think there is a recognition that communication is very important, and giving reassurance to markets is also important. I wouldn't go beyond that.
Well, in the context of my question, I would take this as a very clear response. Caroline, on this?
I don't want to comment on what's just happened, but I will just say that in over many years of working in different kinds of financial crisis, or in different kinds of crisis, actually, I've generally concluded that early transparency is helpful. It always seems nerve-wracking, but generally it turns out that people's imaginations can be more dramatic than the facts, and that a way forward can often be to be transparent. But I really don't know the details, what the Fed has announced or their reasoning. So that's just a very general comment about the benefits of transparency.
Yeah, that reminds me, in Tim Geithner's book, Stress Test, there is a very nice discussion of the early days of the Fed stress test and the internal debates inside the Fed on whether to go for more supervisory transparency, bank by bank result at a moment of turmoil, the internal opposition to this, and how the view that transparency was good eventually prevailed in 2008, 2009. I think it's a very interesting episode to revisit and reread in the context of the current announcements. But I'll leave it at that because both of you have been cautious. There are a number of questions from Ted Truman, from Elliot Posner, from others about how real the current cooperation can be in a time of protectionism, some country wanting to put themselves first, as they say, and populist politics. Elliot Posner, for example, asked it this way: populist politicians have targeted the international trade regime as part of their economic nationalist agendas. Is the international financial architecture's next target? So we've already addressed that a bit, but can you give us a bit more color, again, starting with Dietrich and then Caroline?
Well, I would say the positive answer from somebody who is supporting an international cooperation body that is essentially technocratic. Right? I mean, we are sort of technical experts. My answer would be a positive one in the sense that you would be surprised if you knew the details how close the cooperation can actually be, and how much interest there is in collaborating, sharing information, comparing notes on experiences, and so on. Among our membership. Just to give you one example, we initiated a couple of months ago at the beginning of the crisis an exercise of sharing information on policy measures taken, and there has been a tremendous demand for the information that we collected through this simple mechanism, and so this alone, I think, is a simple illustration of how strong the cooperative spirit at the technical level is.
Caroline?
That's very good to hear. But as I commented, I think that you will be facing, and the world will be facing, issues that require some political input. And there is that, it's as if the link between the technical and the political at that international global level is not present. And I think that's a big problem. I don't expect the G20 leaders meeting to be very functional, and that maybe puts more pressure onto the technical bodies, but it also takes away the ability to make some things happen. To the first question, I don't think that people will go after. Trade is a much easier issue for politicians and political actors to grasp than finance. Although you might have some things about, well, who's going to buy our government bonds, or are we going to sell the currency is going to be driven down by political moves. But I think in the end, none of that actually will happen. So I don't see that political risk.
The financial folks are fortunate that populist politicians don't understand what they're about, right?
Mostly, yes.
That's a reassuring thought, I guess, or maybe not. I have a question from Mikis Haji Mikhail on market access. And I think that's a very interesting question. He asks, major central banks and governments have provided financing and liquidity, but there's a significant part of the private corporate and SME sector in advanced economies and emerging markets, and some governments in emerging markets and developing economies that have limited or no access to market financing. Would this lead to a deeper recession or financial crisis as the COVID-19 lasts longer than expected? And I would link that to the point about liquidities that you addressed, Dietrich, in your introductory remarks. Also a hook for me to mention that our next session in 2 weeks' time on July 7th, I think, will be about the liquidity episode of mid-March. And we'll have Anil Kashyap talking about that together with Peter Fisher. But I mean, there are these two views, right? There is Mikis' argument that those actors, emerging market governments, SMEs, have no market access, but at the same time, there has been this flood of liquidity provided by central banks in a largely coordinated manner. So on which side? Let me ask it as a black and white question specifically to Dietrich. On which side are you? Are you among those who are concerned about market access, or are you among those who are reassured that the massive intervention of central banks has basically fixed these issues?
Well, first of all, I would say the issue of market access, as described by the colleague who asked the question, is to some extent a reflection of the nature of the shock. It is a genuine real economy shock that is hitting a lot of sectors, not least services, with a lot of SME type players. So starting from that point, if you think, well, what would be the alternative? The alternative is perhaps one where you have a crisis where market access is no problem. And they would say, maybe that's a sort of traditional financial crisis where the central bank can very easily get the liquidity to those who are in need, financial institutions. Now, if you compare these two situations, I would say, well, from a financial stability perspective, it is probably better to be in a situation where you can focus on working with a resilient and functioning financial system, in this case, banks in particular, if we're talking about SMEs, obviously, to address the issue of market access, than having to deal with a situation of financial instability. But I think the bigger point that we have seen in March in a number of manifestations and shades is, well, if you provide liquidity support, be it through central banks, be it indirectly, if you like, channeling through commercial banks or other private sector entities, how can you make sure that the liquidity gets to the entity where it is needed? And this is obviously not just an SME issue, it is also an emerging market issue, has been an emerging market issue in a number of forms. But again, having to deal with that issue, I think, is still better than having to deal with an acute financial crisis, I would say.
Nicolas, can I just jump in there? I think what was remarkable in March was the severity of the collapse of confidence, the crisis, the lack of market access, withdrawal of funds from emerging markets, but also the speed with which that was turned around. So exactly. We had an enormous flood back into emerging markets. We had all sorts of corporations in the United States able to access private markets and not needing to go to the official facilities. So there was a floor put under a lot of that market access. I think the problem remains, and especially because of the nature of the crisis, twofold. One, there's the reallocation need over time for productivity and so on. At some point, you want to channel to support the proper, I think Jay Powell said they didn't want to be an elephant stomping all over market signals. At the moment they are a bit, but then more immediately, there are a lot of small businesses and individuals who don't have access to the channels through which credit comes. They maybe raised money on their credit card, they had some savings, and those businesses are going to are in real trouble, and there isn't really a way to get money to them through the financial system. And over time, that if the crisis goes on long enough, that spills into bigger issue.
There is a question which is kind of related to that, but really about equity markets, and that's from Zhang Liqing, who is actually watching us from Beijing. He's at the Central University of Financial Economics, and I'm very grateful to those who stay late to watch us from Asia. And actually, I can happily announce that we'll move the next sessions a bit earlier in the day so that they can find it a bit more convenient, because we have noted that there was a lot of enthusiasm for our series from East Asia. So thanks, Li-Chin, for asking the question. The question is, how do you explain the strong rebounds of US stock markets into the crash in March, in spite of the significant decline of the real economy? And obviously that's slightly different from the credit liquidity, but related to the same views that, you know, things have been in turmoil for a very short time in March. Dietrich, how do you think about it? This is not investment advice, right? But how do you think about it?
No. Certainly not. Well, I mean, if you apply sort of simple equity valuation models, then you would say, well, if your discount rate or your expected discount rate goes down, prices would go up. I think this sort of shift in expectation that has happened in terms of the outlook for interest rates has certainly played a role, I would say. But to some extent, it's also a reflection, I think, of a decline in receding risk aversion. Now, all that said, I think there are a number of indicators, metrics, comparisons that you can make that can be interpreted as if you like, a disconnect between the recent move in equity prices and, say, consumer confidence or the degree of uncertainty about economic growth going forward. So I think there is a question mark out there, and this is clearly, I think, a development that warrants close attention.
Nicolas, if I can just jump in, we've spent a lot of time worrying about this and wondering about this, and of course, Dietrich is right that the policy response, the overwhelming policy response, and I would add the fiscal policy response as well as the monetary policy response, really has pushed up equity markets and reduced risk aversion. Even on days when terrible economic news, there are a couple of wild cards, I think. One is, one important point is to remember that the big 5 or maybe 6, if you include Tesla stocks, tech stocks, are the ones that have really led the market. If you take them out, the broader based indices have not had anything like the same recovery. And the NASDAQ, of course, has had a super recovery. So there's a question there about, is that going to last? Are those companies going to be able to keep their earnings up? What happens if they're not? Will there be challenges to them, to their market power, et cetera, et cetera? And then the second thing is that the VIX has remained quite high, even as the stock market has gone up. So there is some evidence that institutional investors are a little more anxious than than retail investors. So I think there are some ways to explain what certainly does look like a disconnect.
We're getting close to the end of our session, and unfortunately, because it was a very rich discussion, we haven't been able to answer all the questions. So my apologies to Martin Gore, who asked about expected loss provisioning, Tim Clausen about corporate debt, Brad Smith about pensions and FSB membership, Lynn Exton about non-banks, George Sapari about the doom loop, Maurice Goldstein about stress tests. These are partly questions that we address, but partly new topics that we won't have time for. I would like to, and I apologize to them, but I would like to end on the last question, which again comes from Korchak, and particularly in the US context. Should banks suspend dividends and preserve capital in these moments? Brief answers, please, Dietrich and Caroline.
Caroline, would you like to go first?
Yes. I think the answer is yes, particularly on buybacks. That answer is partly a political answer. They don't want to be in the firing line, I imagine. And I think that puts them in the firing line.
So the banks should suspend dividends. Dietrich?
Well, the buybacks in particular. I'm sorry, you said buybacks and dividends.
Well, but buybacks they are suspending, so should they also suspend dividends?
They maybe should. It's difficult. In the US, it's difficult.
We're short of time. Dietrich?
Well, as you would from me, I can give you the kind of answer that I guess you would expect from me, which is there are a couple of arguments that need to be considered, which partly have to do with assessments about sort of seeing the ability to tap equity markets and raise capital in a sort of repeated game context. If you sort of don't allow banks to pay dividends or pay dividends in particular, then to what extent would you inhibit that channel from working? The other argument is, of course, to say, well, how can you allow banks to pay dividends when there is public sector support on such a large scale? So there are arguments on both sides and different views in different jurisdictions.
On this cautious note, I want to warmly thank our two guests for a terrific discussion. I'm particularly grateful to both, actually, to Dietrich, because it can be challenging for officials in positions like his to participate in public debates, given how much of the business is based on trust between participants in FSB discussions. So you gave us a glimpse of that, and I really give you credit for this. And to Caroline for the extraordinary insight she gave us, and also, of course, for her continued engagement with the Peterson Institute that has been extremely beneficial for us all. So sorry for ending again a few minutes out of time, but almost there. And thanks a lot to all the participants who stayed with us during the meeting. I look forward to the next one. As I said, Annabelle Gonzalez in Tradewinds will have a session on the UK next week. And for my part, in 2 weeks' time on July 7 with Anil Kashyap and Peter Fisher on the liquidity episode of mid-March. Thank you very much. Have a very good day.
Thank you.
Thank you very much. Bye-bye.
Thank you.